Good morning. It is Wednesday, April 8, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 12 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East remains in a state of high-intensity conflict. Following the formal expiration of the military reprieve earlier this week, United States and Israeli forces have maintained a sustained air campaign targeting Iranian command centers and missile infrastructure. Overnight, reports from regional monitoring groups indicate that strikes have expanded to include several industrial zones in southern Iran, aimed at degrading the domestic production of long-range drones. This escalation occurs as the humanitarian situation reaches a critical threshold, with the number of displaced persons across Lebanon and the wider Levant now estimated at over 1.3 million. While diplomatic channels in Geneva remain technically open, the rhetoric from the new Iranian leadership remains focused on a prolonged war of attrition, leaving the prospect of a regional ceasefire in a state of extreme fragility.
Transitioning from the front lines of conflict to the broader global economy, the narrative is being driven by the visceral reaction of energy markets to the threat of intensified hostilities. Crude oil prices have surged to their highest levels in several sessions, with Brent crude frequently breaching the $116 per barrel mark following the latest warnings from the White House regarding Iranian energy infrastructure. This supply shock is being managed by a special coordination group formed by the International Monetary Fund and the International Energy Agency to mitigate what they describe as a historic energy shortage. Despite a projected global growth rate of 3.3% for 2026, economists warn that the persistent closure of the Strait of Hormuz is creating a structural drag on industrial productivity, particularly for energy-dependent manufacturing hubs in Europe and East Asia that are already grappling with new trade surcharges.
In the realm of finance, all eyes are on the credit markets as they process the dual pressures of geopolitical risk and a sudden contraction in private lending. Overnight, the private credit sector faced a significant stress test as several major funds moved to limit withdrawals following a surge in redemption requests from institutional investors. This move has raised concerns on Wall Street regarding the liquidity of the non-bank lending structures that have heavily financed the recent artificial intelligence boom. Simultaneously, the 10-year United States Treasury yield remains elevated at 4.39%. Reflecting investor anxiety over sticky inflation and the long-term cost of sustained regional instability. As the market processes the latest labor data, the financial sector is also weighing the impact of potential record-breaking IPOs in the aerospace and defense sectors, even as capital continues to rotate toward defensive assets amidst the mounting uncertainty.
Turning our attention to the technology sector, the focus has shifted toward the high-stakes paradox of massive valuation expansion and growing infrastructure risks. Reports released this morning highlight a growing concern that the AI revolution is facing a physical power ceiling that could stifle growth in the coming years. While companies like Nvidia and Broadcom continue to see unprecedented demand for AI hardware, the global grid is struggling to accommodate the 92 gigawatts of additional electric power projected to be required by next year. This energy bottleneck is forcing a radical rethink of energy procurement, with hyperscalers now exploring direct investments in modular nuclear reactors to ensure their hardware remains operational. Furthermore, severe shortages in essential components like high-bandwidth memory are beginning to redraw the global supply chain map in favor of localized production hubs in North America and Europe. Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are currently facing a period of intense structural rewiring. The Strait of Hormuz remains in a state of near paralysis, with maritime traffic having plummeted to just a handful of tracked vessels in the last 24 hours. This de facto blockade has forced major ocean carriers to maintain the Cape of Good Hope as their primary route, a detour that adds up to 14 days to voyage times and has triggered a structural shortage of vessel capacity. Logistics analysts warn that even if the strait were to reopen tomorrow, the ripple effects on port capacity and equipment availability in hubs like Jebel Ali and Salalah will be felt for months. As a result, 72% of trade professionals have now prioritized the adoption of AI-driven adaptive networks, moving away from just-in-time models toward a just-in-case strategy that emphasizes regional inventory buffers.